Well, hello there. I'm Gemini. That battery can last up to 24 hours even with the always-on display turned on. That's pretty cool.
All right, let's get right into it. If you're self-employed here in Canada, you know that every single dollar counts, and finding legit ways to lower your taxable income, well, that's not just a win, it's a huge win. So today, we're going to tackle one of the absolute best, but also one of the most confusing tools out there for business owners. It's called the Private Health Services Plan, or PHSP for short, and we're going to break down step by step how this thing can let you turn your family's health and dental premiums into a full-blown business deduction.
So, let's just ask the million-dollar question right up front. Can you actually write off 100% of your family's health premiums as a business expense? The answer, believe it or not, is often yes. But, and you knew there was a but coming, right? You have to play by a very specific set of rules from the Canada Revenue Agency. And that's exactly what we're here to do today. Demystify those rules.
Here's our game plan. First, we'll talk about the opportunity itself, why this is such a big deal. Then, we'll run through the all-important eligibility checklist. After that, we get to the fun part, the numbers, and how to calculate your deduction. We'll also cover some key scenarios and limits to watch out for. And then we'll wrap it all up with the main takeaways you need to know.
So, what is this magic we're talking about?
Well, it's all built around the Private Health Services Plan, the PHSP. Now, this isn't your average health plan. Think of it as a special framework, a structure, blessed by the CRA, that allows your business to pay for your personal medical expenses. And the impact is massive. Those personal costs suddenly become a legitimate business expense. This reduces your business's net income, which, in turn, lowers your tax bill. And trust me, this usually gives you way more bang for your buck than the regular old personal medical expense credit.
Okay, before we start dreaming about all those tax savings, we have to pump the brakes and talk eligibility. This is super important because it's not a free-for-all. Not everyone qualifies. The CRA has laid out some very clear lines in the sand. It's like a gatekeeper, and you have to meet the criteria to get through. So, let's break down exactly what you need to do to get that green light.
We can boil it down to this simple 4-point check. Number 1, the income test. This makes sure your business is your primary focus. Number 2, you have to use an authorized plan. Number 3, a simple rule, no double dipping. And number 4, and this is a big one, how you handle employee coverage dramatically changes things. Let's dig into each of these right now.
Okay, first up, and this one's a biggie, the income test. You've got to pass this one, no exceptions. Basically, the CRA wants to make sure this tax break goes to people who are truly running a business as their main source of income. It's a 2-part test, pretty simple. Part 1, your self-employment income has to be more than 50% of your total income for the year. Part 2, your income from other stuff, side jobs, some investments, whatever, can't be more than 10 grand. And here's a little flexibility. You only need to meet these rules in either the current tax year you're filing for or the year right before it, so you've got 2 shots to qualify.
All right, what about the other criteria? Well, first, your plan has to be an official government-authorized PHSP. You can't just pick any old insurance plan off the shelf. Second, that no double dipping rule is exactly what it sounds like. You can't deduct the premiums as a business expense and then turn around and try to claim them as a personal medical expense credit. It's one or the other. And finally, the employee factor is absolutely critical. The rules of the game change completely depending on whether you have what the CRA calls arm's-length employees. That's just their fancy term for employees who aren't related to you. And we're about to see just how much that matters.
Okay, deep breath. Let's say you've checked all the eligibility boxes. You're in. Now we get to the part everyone's been waiting for. How much can you actually deduct? The calculation isn't the same for everyone. It really depends on your business setup, specifically whether or not you have employees who aren't family. So you're looking at 2 totally different paths here. Over on the left, you've got the situation for most freelancers and sole proprietors. You have no employees, or maybe just your spouse works with you. In that case, your deduction is based on fixed annual dollar limits. Nice and simple. But on the right, if you do have non-family employees on your plan, your personal limit gets tied to what you pay for them. We're going to focus on that first scenario because it applies to the vast majority of self-employed folks out there.
Right, so let's really zero in on that situation. If it's just you or you and family members running the show, the CRA has laid it all out with very specific annual maximums. The beauty of this is that it's clear, it's predictable, and you know exactly what your ceiling is.
And here they are, the numbers you've been waiting for. Write these down. The maximum you can deduct each year is $1,500 for yourself, another $1,500 for your spouse or any other adult family member you're covering, and $750 for each child under the age of 18. And remember, that's per person, per year.
So let's let that sink in. The key number to remember here is $1,500 for every adult in your household covered by the plan. So if it's just you and your spouse, boom, that's a potential $3,000 deduction right off the top.
And on top of that, you can tack on another $750 for each of your kids under 18. You can see how for a family, this starts to add up really, really fast. It becomes a substantial amount of money.
Okay, so we've got the rules, we've got the numbers. That's the theory. But how does this actually play out in the real world? The best way to really get a feel for this is to walk through a practical example. This will show you not only how powerful the deduction can be, but also highlight a few important catches you need to be aware of. So, let's meet Alex. Alex is a freelance consultant, a perfect example of a self-employed professional. The business is a one-person show. Alex has a spouse and 2 young kids, say 10 and 14. The whole family is covered under one health insurance plan paid for by the business. Critically, Alex has no non-family employees and easily passes the income test we talked about. So how much can Alex deduct? The math here is actually pretty straightforward, which is nice. We just add up the maximum for each person. So we have $1,500 for Alex, plus another $1,500 for Alex's spouse. Then we add $750 for the 10-year-old, and another $750 for the 14-year-old. So what's the grand total? And there you have it, $4,500. Alex can deduct up to $4,500 in health insurance premiums directly from the business income for that year. This isn't a credit, it's a deduction. It lowers the amount of income Alex even has to pay tax on. Depending on the tax bracket, that could literally mean over $1,000 of real cash staying in Alex's pocket year after year.
Now here's a detail you absolutely can't forget. What if you start your business or maybe just your health plan halfway through the year? The CRA says you have to prorate those limits. The math is simple. A 6-month plan means you get 50% of the annual limit. For Alex's family, if they started their plan on July 1st, their maximum deduction would be cut in half to $2,250. This also applies if, say, a child turns 18 mid-year. Their $750 limit gets prorated for just the part of the year they were under 18.
And I want to flag one more critical limitation, because this is a trap that can really bite you. Let's imagine you do have non-family employees. You offer them access to your great health plan, but you make them pay their own premiums. If you do that, guess what your deduction limit for yourself and your family is? 0. A big, fat nothing. The CRA's logic is clear. This benefit can't just be a perk for the owner. If you're going to offer the plan, you have to provide a comparable benefit to your employees by actually helping to pay for it. Wow. Okay, we've covered a ton of ground here, right? We've gone from the basics of eligibility all the way through the calculations and the tricky exceptions. So let's take a moment and just boil this all down to the absolute must-know points that you should be thinking about for your own business.
So, to recap, here are the golden rules. 1. Always check your eligibility first, especially that income test. 2. Know your employee's situation like the back of your hand. It's the fork in the road that determines everything. 3. Burn these numbers into your brain. $1,500 per adult, $750 per child. 4. Don't forget to prorate those limits if you have a partial year of coverage. And finally, maybe the most important takeaway of all, this is a deduction from your business income, not a simple credit. That's why it's so incredibly powerful.
And that really brings us to the final question, and this one is all for you. Now that you understand the rules, the limits, and the incredible benefits, you can start to seriously ask yourself, is a private health services plan the right move for my business? Is this the tax strategy that I should be putting into place? But of course, every single business is different. Your financial situation is unique. So while I hope this explainer gave you a really solid foundation, it's absolutely essential that you talk this over with a qualified accountant or a tax pro. They can plug in your actual numbers and help you make the smartest possible decision for you and your family. Thanks so much for tuning in.